All right, what's going on, everybody? Looks like we are live. Everybody is showing up here. And today, man, what a crazy day. What a crazy day with gold and silver. Absolute bloodbath. Now, obviously, that's considering just single day performance. Silver's down 29% from yesterday's close. Gold is down almost 10% from yesterday's close. Um, you know, still at the exact same price that it was just either days or weeks ago for both. So let's take a look at the charts. Meanwhile, you guys start throwing questions in the chat. Um, anything. Any questions? Just tag me if you have a question for me, and otherwise, I may not see it. All right, let's pull up. Let's pull up gold. So take a look at this. So gold, we're at the exact same price as we were back on here. Let me get rid of that SMA, 200 SMA. Okay. On the 22nd, so 8 days ago, back under 5,000, which, I was kind of surprised that both gold and silver, gold got above 5,000, silver got above 100. I didn't really think they would get above that, but at least so far now, it looks like they're not going to stay above that, at least for now. Given the percentage rise is just absolutely crazy. We could still move higher from here, but it looks like the blow off top, that this was a blow off top that finally has started to unwind here. We'll see. Silver at $82 an ounce, same price that it was back on January 12th, so 18 days ago. Back below 100, it's at $82 right now. Found some good support here at prior resistance, back where December 26th through January 9th, it really struggled to get above this kind of $80 mark, and found some good support there. So we'll see if this does actually mean the rally is over. Again, this does look like a blow off top has finally ended, and we shall see. But either way, kind of a bloodbath for anybody invested in gold, silver, or miners. GDX, the big gold mining ETF, is down 13% today. And GDXJ, junior miners, down 13 or 14%. So just a tad bit more than gold. What's interesting is if you look at like SIL, which is a silver miners ETF, it's only down 14% compared to silver's 30%. So gold miners are down more than gold. Silver miners are down a lot less than silver. So I think that is interesting. Silver junior miners as well, only about 15%. So silver miners are not having anywhere near as much of a drawdown as silver, versus gold is usually more. And today it is more as well. So very interesting. Tag me in the comments when you throw in a question for me. Ask me anything. And if I see it, I will answer it. When does demand destruction kick in for silver? Well, it depends on the demand that you're talking about. There are certain things that you really can't you really can't just replace. Silver is kind of the only thing, just given its physical properties. There are certain things that only silver is able to perform that function. However, silver is just a like a component. It's one of the inputs, and so it might make the overall thing somewhat more expensive. But that doesn't mean that that people are gonna stop. But like for instance, solar panels. Solar panels, eventually you can replace the silver with copper, but that can't happen immediately. And even right now, while there is still more expensive silver, that just makes the solar panel more expensive. And that may that will force out some demand, but it's certainly not going to force out all demand because it's not like solar panels have quadrupled or tripled in price, just like silver has, because silver is just one ingredient, just one input. There are other things where you just can't, replace the silver in it with something else, because you need the properties of silver, but um, the so demand destruction, basically, is not something that necessarily has to happen, at least to a large scale, just because price goes up on one input. That being said, demand is only one side of the equation, and most people who have been predicting large squeezes and parabolic rises in silver ignore the fact that silver price going up brings new silver onto the market, not from miners, because most mined silver is a byproduct of mining other things like copper. Um, but there's a lot of silver coming onto the market right now from a lot of silver holders who have been holding it for a very long time, hoping for something like this. Um, so, and then recycling, the higher price goes, the more it makes sense to recycle rather than just buy newly mined silver. Um, so I think that this is, to answer the question from Carl Smith there, what is your personal belief? Is this the blow off top or market structure breakdown? I it does look like this was the blow off top. It definitely went higher than I thought it would. But so far now it looks like this is, at least for a while, the top has been put in. Um, and then a question from Michael the Archangel. Seems like general consensus was that this was a long time coming, but consolidation was needed to continue higher. I was in at 27, so I'm happy regardless. Um, I guess it depends. Yeah, it depends on who you're talking to. There's never a consensus in a market unless you're just talking about the current price. 'Cause the current price represents what the total consensus is, at least what effect that has on moving it. And so everybody who is buying disagreed with the consensus. Everybody who is selling disagreed with the consensus, and it just turned out that that the buyers were right, up until yesterday, basically. All right, from Big Chicken Lil Ranch. I just heard about the gold to cow ratio and the silver to sheep ratio. Have you heard of this? And would you say it is a good indicator of, as the GSR? I think that's a joke, because I've talked about the gold and silver ratio for a long time as being completely worthless as any sort of a predictive measure of what gold and silver should do. And the reason why is there's no inherent relationship between them. There used to be when both of them were used as monetary metals, but the invention of paper as a monetary technology allowed gold ownership to be transferred as payment instead of physically moving gold for payment. And that eliminated or began the elimination of the need for silver to operate as smaller denomination payments, because on a piece of paper, it can represent any amount of ownership of gold. And so for hundreds of years, the monetary value of silver has declined to the point where today it is not used as a monetary metal anymore. There is no monetary value left in it. It's all industrial metal, or industrial usefulness. It's utility in things like electronics. Now, and again, I've always reiterated that that doesn't mean I'm not bullish on silver, but it just means that you can't look at that ratio and say, okay, well, the ratio is historically extended, therefore it must revert to the norm. That is not true. It does not have to. And in fact, most of the reason why it looked overextended is because for most of human history, the gold to silver ratio was pegged by law, which meant that it was not a natural ratio anyway. It was just, okay, 15 to 1. That's what the government says the value is. And what that caused most of the time was either gold to leave circulation or silver to leave circulation, because it was at odds with what was, the real value of those metals at the time. Um, and so, um, And so just because the gold to silver ratio has contracted now does not mean that it will then go back to being, being a large ratio. It could stay here. It could go lower. There's nothing inherent in that relationship that demands that they be, closer together or farther apart. Okay. The next question came in from Reluctant Skeptic, who said, "What do you think about mining corporations like ABX? Miners are very difficult to pick. As Mark Twain said, the definition of a gold mine is a hole in the ground with a liar on top. Very difficult to very difficult to pick miners correctly. And so, in general, I prefer to go with the index funds like GDX or SIL, or GDXJ or SILJ, or any of them. Rather than trying to pick them yourself or going with the very large established companies where it's like, okay, this is not just a discovery. This is not just a company that's has one or two geologists that are drilling a couple little holes in the ground and they've got one little shack set up on one little hill out in the middle of nowhere and they're just hoping that the gold or silver price skyrockets and they can get acquired by somebody else so that they all have exit liquidity. I prefer to go with the larger, more established companies that are actually producing something, selling something, and pulling in profits. All right. From Espacio, how do you mentally set yourself up to do where you are? How do you mentally set up yourself to do where are you now? Quitting job, trading, YouTube courses. Sometimes wanted to throw out the window everything, especially after losses. Okay, I'm assuming there's a little bit of a language barrier there, but the question is generally about getting over the mental fears to do something that you want to do, whether that's starting your own business, quitting your job, or something else. When early on, when I was in college, I did an international internship for an entrepreneurship overseas in another culture in another country. So I spent 6 weeks in Southeast Asia um, and spent some time with a couple different expats who had started businesses. And so for a long time, from that age in the back of my mind, I was always thinking at some point I want to work for myself and run my own business and hire people and make my own decisions and do my own thing. Um, the problem was I didn't have any skills. Now, I didn't realize that was the problem at the time. At the time, I thought the problem was that I just didn't know what kind of business to do, that I didn't know what I could do to make money. The real thing was I didn't have anything of value to offer the world. And so I became a stockbroker and I started learning skills. I learned the skills of understanding the markets, learned the skills of communication, learned the skills of sales, learned skills of trading and investing. And it got to a point where I was like, okay, well, I'm making hundreds of thousands of dollars per year working for another company. That means I should be at least worth that much to myself. And I have all these skills. I believe that I have what it takes to be able to, at least make enough money to pay the bills. And so in 2019, I quit my job because of that. And there were a couple other factors that got me over that leap. Number one, I thought I had the skills that were necessary. Number two, I absolutely at that point had gotten to the point where I hated my job. I had gotten to the kind of the top of the ladder in terms of how much money I could make doing what I was doing in sales, rather than like if I wanted to make more money, I would have had to kind of climb down that ladder and start up a new path, and it would have taken me a long, long time to even get back to where I was before I started having the potential to earn more. And so because of that lack of runway in front of me, I'd kind of reached there was nothing more for me to shoot for. And my job itself wasn't fulfilling. It was high volume, cold and warm sales. It Because of the lack of satisfaction in I every single day I woke up like, I wonder if I can get away with not going into work today. Like, is there, it was brutal. I really, really disliked what I did every day by the end. And so the pain of the current place was huge. And then the attractiveness of being able to do what I had wanted to do for a long time, which was work for myself. And I believed I had the skills necessary to do that. The combination of those two things pushed me over the edge. Now, if I had been in a situation where, like I actually saw at the time I read the book, The 4 Hour Work Week by Tim Ferriss. And in that book, he recommends, because this was written, I don't know, in like 2006 or something. In that book, he recommends to go to your boss and ask them if you can work remote. And likely you'll be able to get all of your work done in at least half the time. And then you just, have more time available to start a business or just have free time. And I actually did that. I tried to get a remote um, situation worked out for myself. Remember, this was 2019, pre 2020. And so I was like, hey, look, like stuff is changing with my family, whatever. I need to be able to do this job from home. And the answer was just like an absolute hard no. There's absolutely no way. The rules, the regulations, the laws, the infrastructure, there's just not even a chance. And so I quit. If I had waited 6 months, um, there is a chance that my situation would have improved just enough. My mental situation would have improved just enough that I would have never taken the leap to quit, because 6 months later, the world fell apart and every single person was working from home, including everybody that I used to work with. They all got laptops and they all started working from home. And that would have solved a lot of what I disliked about my job. I didn't like the commute. I didn't like going into the office. I didn't like having to be, structured on, the specific hours and all that. And so if I would have been able to spend more time with my family, if I would have been able to be more productive in a smaller amount of time, still make the same amount of money, and I would have looked at the fear of, hey, the world's falling apart. Do I actually have what it takes to go make it on my own? Then I would have felt like I was relatively not in as bad of a situation. I probably would have stayed stuck. And that highlights something called it's a paradox. I can't remember. It's called the beta position paradox or something like that, where sometimes being in a worse position causes you to make a change that lands you in a better position. And that would have never happened if you were in a mildly worse position before. So the example is, if you're 1 mile away from something, then it's very possible you might choose to walk there and it'll take you 15 minutes to walk there. But if you're 2 miles away from something, you're likely to just drive there, and then it'll take you 1 minute to drive there. And so starting off in a worse position of being farther away causes you to make a different decision that ends up getting you where you want to go faster. And so the fact that I hated my life, the fact that I disliked everything I did about my job, and the fact that I felt like I had what it took to get where I wanted to go was enough, where it was like, it's such a bad situation and the carrot was so strong in front of me, that was enough to get me over that leap. And so I don't know if that answers your question or not, but that was what it took for me. Now, spoiler alert, I did not have what it took to make money on my own, at least initially. It took me 6 months to figure out how to make my first dollar. So I went 6 months with no income at all. But once I made my first dollar, that still wasn't enough. It took me another year from there before I was able to start making enough money to pay my bills. So it was a year and a half total before I made enough money on my own just to pay my bills. Then once I figured out how to make money, I started making a lot of money really quickly. And I make way more money today than I ever did before when I was a stockbroker. But that still highlights the fact that you've got to be ready. You've got to have a runway. You've got to have savings or investments that you can rely on to produce income for you, because it's going to take 3 times as long as you think it will, and it'll be 3 times as hard as you think it will. And I had to build a lot of new skills that I didn't have before in order to make it work. All right. Question from JJ99545. Where's the bottom in silver and gold? So let's go back to the chart. Pull up gold. So gold is at 48.58. Silver is at 83. I would not be surprised at all, at least temporarily, to see silver fall back down to like the 55. Markets take an escalator up and an elevator down. So usually in a blow off top type of scenario, you see retracements that are far bigger than you expect, given how long it took the movement to happen, and far quicker than you expect, given how long it take that movement to happen. And then from there, once a real bottom is put in, I would not be surprised at all to see it, move higher again. Long term, I'm bullish on gold and silver. Short term, well, I'll just say short term, I don't have any bearish positions on gold. Sell my long term holdings, didn't sell anything, didn't sell any of my long term silver. But I do have open puts on SLV that at least today are doing extremely well. um, but I think we probably still have a little bit more to go before we hit the bottom. All right, question from A. Murray. Ooh, where did that go? Sorry, guys. There's a lot of questions coming in. Trying to get to them all. When do you anticipate TLT to reach $100? Did recent market activity change your outlook on that time frame? So for TLT to reach $100, that'd be right here. The last time it reached there briefly was September of 24. Basically, we need long-term interest rates to go down because that pushes bond prices up. They're inversely correlated. 20-year rates have been moving higher. 30-year rates have been moving higher. Paradoxically, it seems paradoxical to some. When the Fed lowers the Fed funds rate, that has the effect of pushing long-term interest rates higher. It steepens the yield curve. The reason why that happens is because it makes it easier for the government to borrow money. Borrowing money is is lending money into existence. So as short-term rates go down, the government borrows and spends more money into existence. That increases the money supply. That pushes prices up and inflation up. That means long-term lenders want to be compensated for that loss of purchasing power. That pushes those long-term rates higher because there's no direct intervention at the long end yet. So if we are going to get long interest rates lower and bond prices higher, that will require intervention either through direct QE by the Fed or with indirect QE by the banks through deregulation. I think now that Warsh has been picked as the Federal Reserve, the next Fed chair, assuming that goes through and he doesn't get pulled back or anything, I think that it's very possible we get a very different look at the Fed. Short-term interest rates down, even a winding down of the balance sheet, stopping the current QE in its tracks and starting to aggressively sell off the balance sheet. But that would only happen in coordination with the banks picking up that slack. And so bank deregulation still seems like the way out, where the Fed, somebody like Warsh can come in and maintain his historically hawkish stance, and his stance of being critical of the Fed's QE and propping up asset markets. And so he can come and wind down the balance sheet while lowering interest rates a little bit just to appease Trump. And then through bank deregulation, that is where everybody can kind of save face because nobody really looks at what all the banks are doing. And banks are going to be buying up those long-term treasuries once they don't have to worry about the SLR anymore, the supplementary leverage ratio. I don't know if that's going to happen anytime soon, but I think it has to happen at some point, because the government can't just roll over T-bills forever. I mean, I guess they could. There would be problems with that, though. Specifically, like if inflation starts really getting out of control again, then those short-term rates, then they have to go up, and that makes the interest on the national debt really expensive really quick. All right. Next question from Nishantre. Does the crash have something to do with the new Fed chair? Yeah, it has to do with what I was just talking about, which is that Warsh is historically very, very has been, anti-rate cuts, anti-QE. He's been critical of the Fed propping up assets. It's actually, kind of surprising how much he's been against what it seems like Trump is picking him for. And so maybe it's because a little bit of writing on the wall. You pick him, assets start to fall in price. Then you get to blame Powell. Warsh comes in, he cuts rates. Markets have already fallen now. They start to recover. Then everything is bullish from there. It is interesting to me, though, that he ended up going with Warsh, at least so far. All right. Question from Vienna Weiss. Seriously speaking, the price of gold and silver went up so fast in the last month that everyone should have fully expected a proper correction. The problem is a lot of people who have been buying gold and silver for so long, there's a lot of, I don't like to call it like conspiracy theory stuff, but like there's a lot of I would say information that's not entirely accurate that gets a lot of attention because it feels like you're fighting against the machine. For example, there are a lot of people out there who believe that J.P. Morgan Chase is days or weeks away from going bankrupt because of the silver price. It's it's been a while since J.P. Morgan has been net short silver. I think now they're net long. Um, so the idea that or maybe they're flat, but they there there's no truth to some of these things that people think are true, and so it builds up for a long time. You feel like with all the bleeding and all the suffering and all the waiting and all the times you thought it was going to go up and then it doesn't, like for you to mentally be able to hold on through all of that, once it starts to happen and you start to see the fruits of your labor and finally start to feel like you're getting rewarded for all of the years of abuse that you've been through, um, there's really no price that could happen that could convince you that it's done. Like it gets to 50 and now it's doubled. And you're like, it's just getting started. And then it gets to 75. Now your position is tripled and you still feel like it's just getting started. Now it gets to 100 and your position is quadrupled and you still feel like it's just getting started. Finally, everybody's getting squeezed out. And it becomes mentally very difficult to reverse that position because you've trained yourself for so long. Holding means winning. And so it becomes difficult to change your mind about that and look at the reality of, hey, this is a big move really fast. Usually these are not that sustainable. Usually it means a lot of people have already gotten squeezed out. Usually that means that the buying can be close to being soaked up. But it's hard to reverse that mentality after so many years. All right, from Brad. Can you pin yourself to the upper left corner rather than the lower right corner in the future video? I'm assuming you mean when I'm sharing my screen, like when I do this. Yes, I can. I just have to like manually change it in my switcher. So I guess I'll just eliminate my face since it's blocking things from now on. Instead of doing the picture in picture. That way it doesn't block anything. If you guys have questions for me, make sure you tag me so that I see them. The next question was from Nishantre. Can you check the Bitcoin to gold chart? I mean, yeah, we can pull it up. Bitcoin to gold. So, I mean, I'm not really sure since you asked me to pull it up, I'm assuming that you're aware of where it's at. I mean, obviously gold has been doing a lot better than Bitcoin recently. There's not a lot of I would not put any not faith, but I wouldn't put really any sort of analysis into this ratio. The reason why is because gold is a monetary asset and it's been that way for at least 5,000 years. Bitcoin is something that is slowly, maybe potentially becoming a future monetary asset. So the relative values of those things, I mean, you would expect something that evolves from a zero value to potentially becoming used as a large monetary asset around the world. You would expect the relative value of those to converge over time. And you'd expect for it to be volatile. And also because it's just a competitor, you'd also expect that there's a very good chance that it actually doesn't happen and that Bitcoin could potentially go to zero. All right. Super chat from Matthew. Thank you so much. I really appreciate it. February 4th, there's a meeting for silver and tariffs being recently added to the critical minerals list. February 9th, new 100-ounce silver features are being added to CME. There's also talks about, and by the way, I didn't see a question there, so I'm not sure whether you just wanted me to say that or if you had a question about it. But the floor the floor underneath prices like so far it's been looked at like it's been like individual arrangements with specific companies or producers. There was an article from Reuters that recently came out that said the company MP Materials Corp. Um, and they basically said the price floors are gone. The government's not going to honor them. MP came out and said this is just junk reporting. There's absolutely nothing true about this. Reuters walked it back and stealthily edited the article, and now are reporting that the government is just doing price floors in general underneath specific commodities or minerals, and not doing arrangements with specific companies. Now, either way, the government getting involved in markets always causes problems, whether it gets involved with specific companies, whether it gets involved with things, as large scale over the entire economy, setting price controls, price floors, price ceilings, not good. But it does create winners and losers. Usually the total losses from all the losers outweigh the total wins from all the winners. But if it's going to happen, it's like if the government is debasing the dollar, it's not wrong to buy gold to protect yourself. So if the government is doing something that is wrong, it is not also wrong to do something to position yourself to protect yourself or profit from that. Now, if you are the one that is pushing for that and causing it and, directly involved in exploitation of the economy, then I would say that that's, something to think about and probably something to try and reverse course on. But I wouldn't, I wouldn't have any problem investing in a way to take advantage of the fact that price floors are going to be set under certain commodities. All right. Question from General Watch Account. Do you reallocate gold or silver based on the GSR? Would you recommend? I think I'm not going to reiterate this just because this is going to be going up as a recording, and I spent a good chunk talking about that earlier. In brief, I put zero weight in the gold to silver ratio at all. It is completely worthless and useless and not tied to anything inherent in the value of either gold or silver or in the real world of physics or the economy. It is utterly worthless. So I put zero weight in the gold to silver ratio at all. Analyze silver's value based on its own merits, its own supply, its own demand, and do gold the exact same way. That's it. They're unrelated. All right. Question from Brad. How can the COMEX paper pricing of silver be 83 and the Shanghai physical price be 123 at the same time? Because there's a difference between the spot price of something and the price of something to get it physically delivered. When you are looking at something that requires physical delivery, you're talking about transportation, you're talking about security, you're talking about electricity, you're talking about energy, you're talking about insurance. So physical markets are always going to be more expensive than like the spot price. Also, there's a difference between that and speculation on what that price will be. So this isn't the boogeyman that a lot of people think it is. It is completely normal and natural. Maybe it's more extreme than it should be, which you'd also expect during times of insane price movement, dropping 30% in a day. However, it is completely normal to see differences in price between physical markets and paper markets. All right. Question from Israel. Due to hard times like this, would the market shift to silver as a store of value more and more? Would that not cause industrial investors to be afraid? No. Um, no, the answer is no, because most of silver's value comes from its industrial usefulness, which means that trying to use it as a store of value, as a monetary asset, is more dangerous, more risky, because some of its value could drop as a result of its industrial usefulness dropping. Um, so this is like money is whatever is money is the most marketable good or the most saleable good. All throughout history, that's what becomes used as money. It's just the good that is the most marketable good. And the characteristics that make something more marketable are things like, hey, it doesn't rot after a couple of days. It doesn't mold. It can't be eaten. It's hard to counterfeit. It's easy to identify that it's real. Um, it's easily divisible into smaller chunks. So this is why like things like cattle have been used as money, but they didn't last very long or go very far around the world because you can't make a payment with a half of a cow for, rent for a month. Um, Things like rice have been used as money, but it goes bad after a long time. And so the things that make things useful for something like food, or as a good used for other things, utility value, those things end up really detracting from its monetary usefulness. The things that make it useful as money, being the most marketable good. And so, kind of in an evolutionary process, gold became used as money because its characteristics led it to be the most marketable good, which meant that it actually had the least utility value for other things. Most of its value is tied to those characteristics that made it good as the most marketable good, which also just means all money is always just something that people accept as payment just because they know somebody else will accept it as equal or better payment at some point in the future. And the longer of that time horizon, the better it works as money. So I will accept gold as payment because I know whether I want to use that and turn around and use that for real payment in a year or 5 years or 10 years or 100 years, I can. And that is not true about things like rice or seashells or cows or something. And so as the monetary usefulness of something rises in terms of its characteristics, the uh, utility value of it actually is decreases. There's less utility value in something that has the most monetary value. Silver, its monetary value was as change for gold for smaller payments. The invention of paper eliminated that need because paper allows you to transact with gold in terms of transferring the ownership rather than moving the actual gold. So it's infinitely divisible now. Um, so it started eliminating the need for silver as a monetary asset. Well, also, over the last 100 years, silver's industrial value has skyrocketed because it's become very useful in technology, electronics, medical devices, solar panels. And so, as something's utility in applications like goods rises, that decreases its monetary value because its ability to be used as a store of value goes away as its value becomes more volatile relative to how it's being used in an industrial sense. And so no, the answer is hard times like this do not cause markets to shift to using things like silver or copper or gasoline or oil as a store of value, um, because those things get their value from how they're used. Um, they're not they're not getting their value as money does. Okay. Next question was from Julio Gutierrez. Hi, Joe. Do you know what's going on with Iran? I have a $15 call for January 27, but would like to take profit sooner. Um, I mean, when a stock is it's just, like any other asset, large moves up also are paired with large moves down. Um, Volatility goes both ways. Um, so I mean, when you look at a stock that moves that much, a 60% drawdown is very common. Within the last year, it's had 2 or more 60% drawdowns. Um, and so, yeah, volatility goes both ways. All right, question from JJ. Do you have a book we can read to become an investor of your capacity? A book? No. I spent years reading a lot. I started off with the goal of reading like one book a month. That was 12 books by the end of the year. I did that. So then I doubled my goal. I read 2 books a month. I did that, tripled it. And then 2023, I believe, I was my record year. I ended up reading 100 books in 2023. But it got to the point where I'm like, yeah, you've worked through so many books that you're like, okay, well, all of the good lessons to learn and apply, I've kind of like filed away at this point, and now it's just a matter of doing it. So what you'll find is a lot of people who are fairly successful talk about how they went through a period of time where they read a lot of books and they absorbed a lot of information, and then they ended up just stopping doing that and just doing the work instead. And I've kind of found that to be that's kind of the process that I've gone through as well, because it gets to a point where you're like, okay, I'm not just learning more and stuffing more information into my brain is not helping me. I just need to actually go out and do the things that I already know I need to do now. In the beginning, you don't know what you need to do. So there is a phase where you have to stuff that information into your brain. And it's a numbers game because most books are bad. Some books are good and few books are great. And so you have to get through a lot of books to find the great ones. Once you do, reread them. And once you've absorbed everything, you're like, I know what I need to do now, then go out and do it. Some of my favorite books on investing are all the books by Jack Schwager, the Market Wizards books. He's got Market Wizards, Unknown Market Wizards, I think Hedge Fund Market Wizards, the New Market Wizards. He's got a bunch of them. Those are fantastic. All the Nassim Taleb books are fantastic. Anti-Fragile, Skin of the Game, Black Swan, the Almanac of Naval Ravikant. Man, that is hard to say. That's a really good one. Atomic Habits by James Clear. That's a really good one. So I would start with those. All right. You often show the Fed's. This is from S3BCIU2. Do you often show the Fed's balance sheet? Why do you not adjust for TGA and reverse repo for net liquidity? TGA is entirely useless as any form of long-term metric on anything because it's just the government's checking account. That's it. So short term, there are changes because money goes from the economy through taxes or borrowing to the government and stays there, and then it goes back out. And so when the government has shutdowns and debt ceilings and things like that, it'll spend everything down from its checking account. And it gets to the bottom, they suddenly magically fix the issue, come to an agreement, and then they start stockpiling that account back up again. So over the long term, it's an entirely useless metric. It doesn't matter at all because it's just their checking account goes down, goes up, but ultimately it's just the pass through. It's just where money sits while the government decides when or where to spend it. And so it doesn't, the only impact it has is short term, and it's very short lived. It's not, it's not a huge impact. The Federal Reserve's balance sheet is very different. Number one, because of the sheer size. I mean, the Federal Reserve's balance sheet is like trillions of dollars versus the TGA maxes out at, $800 billion before they stop stockpiling more, and they, end up spending it down. So the sheer size difference is huge there. And then reverse repo and the repo facility, both of them at the Fed, again, those are now short term. They're not being used anymore. The reverse repo is there for excess liquidity from all the printing they did during 2020 and 2021. That's gone now. They sucked it all up. So they're not being used like they were a couple of years ago. So it's not necessary to look at them. All right. Next question was from Daniel Murray. Talk about Kevin Warsh, please. What's going on with the Fed now? So Kevin Warsh, if you haven't heard, he's the new Trump announced he's going to be the next, or he's who Trump is nominating for the chair of the Federal Reserve. Very interesting because he's historically been very hawkish. So he's been critical of the Fed's QE about propping up markets through, buying assets like mortgage-backed securities and treasuries. He thinks well, he's also been critical of like ZERP policies and low interest rates that were too low for a long time. So it seems just historically like his stance has been at odds with the reason why Trump is trying to get rid of Powell. Um, Now I think that he will be okay lowering interest rates, the Fed funds rate, with reducing the Fed's balance sheet. So I think it's very possible that he gets in there and puts an end to the current QE that the Fed is doing right now, and then maybe even starts to wind down the balance sheet again, maybe even aggressively start selling assets to wind it down. But the only way that the Fed can actually do that is if somebody else is buying. Right now, there's not the capacity for that. The only buyers of treasuries that don't care about the absolute rate are banks. You and me, when we put money in a checking account, a savings account, a money market fund, or a treasury, we care about the absolute rate. So when we see 4%, we're like, I'm not going to break even after inflation, so I'm not going to do that. I'm going to invest instead. The only people who don't care about that are banks because they're not investing their own money. They're taking your dollars and they're investing those dollars in treasuries. So they only care about the spread. So if they can get 3% on something that they have to pay you 0.1%, then that's free money to them. So they want to do that as much as possible. The problem is banks are restricted by how many treasuries they can buy because of something called the supplementary leverage ratio. During 2020 and 2021, that was temporarily suspended, so banks could buy an unlimited number of treasuries and didn't have to worry about that ratio, that restriction. But that suspension was temporary; it ended. They do have to worry about that now, and so many people, like Stephen Moran and others, have advocated for deregulating the banks, getting rid of the supplementary leverage ratio, treating treasuries as reserves, so that banks can just go in and buy as many treasuries as they want, and they will. And so it would effectively allow the Federal Reserve to wind down their balance sheet while the government gets lower long-term interest rates because the banks are taking up the slack and banks are just going crazy, just absorbing all the treasury supply out there, buying it all up, driving up prices, driving down long-term interest rates. And so if Warsh does get in there and does do the things that are consistent with his historic stances, I think that the only way that's possible is if that's paired with bank deregulation. All right. Question from General Watch Account. For those of us who have come from a macro first framework and usually need narrative to feel conviction, how do you think about trades that are purely technical with no obvious news yet? Trades that are purely technical with no obvious news yet, not always, but oftentimes are moves that are happening ahead of the news. Like if you see the markets in general are all falling, um, let's say especially in tech or semiconductors, but there is one that's going the other direction and doing very well. Um, Usually that's a signpost, that's a signal. Or let's say you're just looking at the chart. Oftentimes, well, because the chart is just a visual representation of group behavior. And so that pattern of group behavior where there have been a bunch of people who are buying and they're willing to buy at higher and higher prices, or maybe they're not and they're only willing to buy at lower and lower prices, and then sellers also doing that same thing, that will show up. That's just visually what you're looking at on the chart, is just what the group behavior has been along the way. And so when you see something happening there, all you're seeing is a visual representation of something fundamental that's going on. Maybe that's institutional accumulation. Maybe that's a short squeeze starting to pop off. Whatever it might be, the charts are just the visual representations of things that are happening, the fundamental things happening in the real world. So I don't have any problem with making trades just off of the charts. Many times I find that when something is showing up on the charts, there's something fundamentally that is causing that. All right. Question from Julio Gutierrez. Thank you for the super chat. Appreciate it. Oh, do you know what's going on with Iran? I did mention that I talked about that question earlier, but I mean, just full disclosure, I'm long. I am very bullish on Iran. There's even just a couple days ago, and there was some politician who sits on some decision making board who opened up a new position in Iran. Um, it looks like there's a good chance that they're going to be announcing some deals with some more companies, maybe Microsoft or Amazon or somebody like that. That it's possible that doesn't happen, but um, it's I overall I am still very bullish, but you don't get large moves without large drawdowns for the most part. Volatility goes both ways. And so when you have a stock that has done 60% drawdowns within the course of a year, um, moves of 5% or 10% or even 15% in a day, to me, like those are kind of the what would you call it? The not the Yeah, the like the cost of access. It's like if you're looking for something that can move drastically in your favor, you're also going to need to expect that it will do the opposite along the way. All right. Next question from, I believe the next one is from General Watch Account. Do you avoid exercising options and close the trade, or case by case? If you want long-term exposure, buy separately. Thinking about XOM and your trade alert. I rarely, well, very rarely. I don't actually remember the last time I exercised an option. The well, I do that when I do it on accident. So sometimes sometimes I make a stupid mistake and I forget to check my account on, a Friday before the market closes. And sometimes every once in a while it'll expire in the money. And when an option expires in the money, you get exercised. Now, if an option exercises because it expired in the money and you didn't catch it, as if you notice it before while the aftermarket is open, you can usually call your broker and say, hey, I didn't mean to do this. I would like to, let's say it's a call, say I'd like to sell these shares immediately in the aftermarket hours, even though I don't have them yet, because I know they're going to get delivered through this option being exercised, and they'll do that for you. You probably won't be able to do it yourself because your account won't be able to support that sale without actually having those shares there, because this is not a short sell. This is not you engaging in a short sell. This is you engaging in a long sale that you just haven't delivered the shares yet. So it's a long sale with the delivery coming after through the exercise of the options. So usually you have to call to be able to do something like this. If you don't do that, then you'll just Monday morning you'll have the shares and you'll have to sell them. And hopefully market hasn't gapped down over the weekend. Hopefully it's gapped up for you. But again, that's a risk that you're not trying to take. That's a different trade. So you never want to bank on that. That's something that usually you're not, is not part. That's just you accidentally did that from a stupid mistake. Lastly, if your account cannot handle the exercise because it would cause you to overbuy your purchasing power, sometimes your broker will just put do not exercise instructions on it, which means you just lose the intrinsic value that was there. It just goes away, it evaporates, it disappears, and you miss out. So it's never a good idea to just let them expire if they're close to the money. I always close them out unless they're really far away from the money and there's no chance. So I can't remember the last time I exercised on purpose. And the reason why is because you're only going to exercise on purpose. Like, the only time that would make sense is if you're doing it like at expiration. If you're doing it before that, you'll get more money by selling the option because there's time value on it. The only case where that's not true is if it's super far in the money and it's very illiquid. And so the bid and ask spread is so wide that you can't actually get a fill at its intrinsic value. If you can't get a fill at the option's intrinsic value, then you do want to exercise, immediately sell in the open market, probably first. And then you get to capture the full intrinsic value there. But other than that, there's really usually no reason to exercise. Maybe stealing the dividend. Again, these are small little things I don't really ever concern myself with. All right. Question. Thank you, Joe. Following your advice on side hustles. Can't wait to go back to Heresy Financial University and resume the asymmetric angle of investment. All the best. Well, thank you. I'm glad you are enjoying it. Question from Israel Sampson. When you try to find books or when you read books, do you prefer them when they are more mathematical and all formula or more logic, historical explanation, and exemplary? I don't like books like I listen to books. So that's one thing. It's like a lot of people say that it doesn't that like audiobooks don't count as reading. When they've done studies on brain activation and memory and like information retention, there's zero difference between listening to audiobooks versus physically reading books with your eyes. Um, and so, but it does change, in my opinion, change the books that you read because you can't see anything. And so, if there's diagrams or formulas or things like that, then you're that's it's not going to be a good book to listen to. Also, I don't like fiction. It's just boring to me because reading to me is work, and I don't like having to work for a story. If I want to enjoy a good story, I don't want to have to work for it. I'm going to watch a movie. And a lot of people say you don't get as good of stories in movies or TV shows as books, and it's like, fine, then I'm missing out. But I don't, I don't like reading fiction. So, so I like listening to books that are nonfiction that are that have some amount of narrative in them that is easy to listen to that you don't need to see it with your eyes. From Vienna Wise, thank you for presenting everything so clearly. Well, thank you. My pleasure. I'm glad it's helpful. From Tasmania. How does today impact the commodity super cycle? Does the volatility somewhat play out this thesis a little bit? I'm not saying it's done, but accelerate the thesis. Yeah, I don't think. I mean, precious metals, especially doing something like this. Usually, what happens is like gold makes its move first, and then other commodities, and then energy tend to follow. And so and part of that is because gold tends to front run monetary policy, but then monetary policy is what moves the rest of the world. So there's nothing about this current last couple of days or this move in precious metals that invalidates the commodities super cycle that I think is playing out right now. This is a very long term thing that happens over years or decades. This is not something that takes place over weeks or months. All right. Next question from BTCH Hopper. Hey Joe, just got here. Sorry if I'm repeating, but where do you think the markets are going short term? Are we starting a longer downtrend, or is this a hiccup? I'm still bullish. I think that the consolidation I'm assuming you're talking about overall markets, like the S&P 500 or the Nasdaq, look to be a volatility consolidate. Let me pull up the chart. So this is like we've had a lot of volatility since we've been in this range for a while now, since really September. Been bouncing around in this range here. Same thing with the S&P 500. A little bit more squeezing, a little bit more compression there, some price consolidation. But you get a lot of flush outs that happen during price action like this. And so obviously we can break out the other way and you can see this thing turn down in a second. But we just had a 20% bear market a year ago. And in the span of 5 years, we had 20% plus 20% plus bear markets, which is kind of unprecedented to see that many large drawdowns in such a short amount of time. Plus valuations, to me, I know there's a lot of fear in the market and there's a lot of talk about bubbles and AI bubbles and things like that. However, it just depends on how you're measuring these things. If you look at, for example, the PEG ratio of the Mag 7, it's at its lowest point it's been since there's a brief time at the bottom of the bear market in 2022, and it's going back to 2018. So the PEG ratio is the price to earnings divided by the growth of those earnings, and so the current valuation of the expected growth of earnings right now on Mag 7 is very, very low, historically speaking, over the last 10 years. So it just depends on how you're measuring value, and it's not clear that that valuations are stretched and high across the board. But if you're talking about metals, I think this is a blow off top, and I think it's the top is in for a while. Long term, I'm still bullish. It's not going to make me sell my gold, but I think I'm still long my puts on silver, and so I think those will probably end up being a little bit more profitable. All right. Question from Matthew. I know Robinhood was in huge favor of the new 100-ounce silver contracts. They offer 10x leverage, allowing 800 1,000 to enter silver market with 60/40 long short tax rates. Yep. Um, when you see big moves like this, tends to be from a lot of leverage and a lot of leverage being unwound both ways. Um, so yeah, not really a question there, but um, what would be a good strategy for deploying cash into gold and silver given current market conditions? Um, I'll talk about gold. I think I think there's no difference. Like there personally, I wouldn't change my strategy for getting into gold right now based on what's happening with price. Because over the long term, gold preserves its purchasing power. It's what I use as a savings account. And historically that's proven to work very, very well. Um, I maintain around a 20% allocation to gold, 30% to stocks, 5% Bitcoin, 5% cash, 30% real estate, 10% speculation. And so that's, an initial allocation, but also with new money allocation. So for every, $1,000, that would be $200 going into gold. In the beginning, that auto rebalances your account for you because as the values change relative to each other, you're buying more and buying less relative to each other. Over the long term, though, as you do get to the point where you need to rebalance, then you're taking advantage of the relative changes in values between things like gold and stocks. And so you're taking advantage of, hey, like right now, gold has been doing a lot better than stocks. And so maybe your gold allocation went from 20% of your portfolio to 40% of your portfolio. It means by selling gold and buying stocks, through that rebalancing, if assuming you're choosing that same allocation, means that relative to each other, you are buying low and selling high. And that would have also meant that like 5 years ago, you would have been doing the opposite. And 10 years ago, especially. So um, the long-term view, I don't think changes, and the strategy to accumulate assets appropriately with low correlation across your portfolio. I don't think changes based on what's going on right now. Um, all right. If government spending stays the same, how much do you think the new Fed chair will change the dollar's depreciation based on certain decisions he will make? Um, hmm, that's a big if. Government spending has never stayed the same ever. It always goes up. It briefly dipped in 2022. But when you account for how much extra was spent in 2020 and 2021, on average, it still has gone up drastically. So over the long term, it never goes down. Um, it always goes up. And so as government spending continues to go up, that means taxing and borrowing continues to have to go up. And as borrowing goes up, that also means that the money supply has to continue to increase because you get to a point where there's no dollars left to borrow because you borrowed them all. That's what happened in 2019. That's what happened, a couple of months ago when they restarted QE. And so, um, and also because as money comes into existence, money is lent into existence or lent and borrowed into existence, which means every new dollar that adds to the supply is also adding future demand for more dollars because you have to pay that dollar back with interest, and that extra money has to come from somewhere. And so as the government increases its spending, its borrowing, its taxing, you must continue to increase the money supply or else you face a deflationary death spiral. That's the one thing the Federal Reserve is never going to let happen. That's like the legacy of the Great Depression to them is that they didn't print enough. So they will never let a deflationary death spiral happen. Um, they'll always expand the money supply at least enough to prevent that. And so I don't think it matters who is in charge at the Fed, whether they do this through interest rates or do this through QE or do this through bank deregulation or what. The money supply will continue to expand to support the government spending because that is the mandate. Go read the Federal Reserve Reform Act of 1977, which is the thing that Congress used to give the Fed their mandates of maximum employment, stable prices, and moderate long-term interest rates. All three of those are just stealth ways to make sure the government has spending power. Maximum employment is the maximum tax base. Make sure as many people as possible have to work for as long as possible because that's who we harvest taxes from. Stable prices means make sure that prices continue to go up and never go down because we need to borrow at a rate that is lower than the rate of inflation. Make sure that people have to continue to work, make sure that asset prices continue to go up so we can continue to tax things, capital gains, make sure that anything that we don't get in taxes, anything that people protect themselves by buying assets from that inflation, we get to tax with capital gains. So stable prices, making sure they get more money, and then moderate long-term interest rates, making sure that they can borrow at a rate lower than the rate of inflation. So it's all about the government being able to spend what they want to spend. That's why the Fed exists. All right. Thank you for the super chat, EC Money. Thoughts on Microsoft longs? 12% drop on decent call. Yeah. Let's pull up the chart. Microsoft, big drop, even though they beat earnings. And that's mainly because of the unexpected increase in CapEx spending. So this highlights kind of something new about like technology is that, we're probably moving into a period of time where margins start to compress. This isn't something anymore where it's like, technology is, free money. Big expensive spending has to continue to increase. Now that doesn't mean that those companies won't continue to do well. I think if you look at the way that Microsoft, so I'm not long Microsoft, by the way. So this is an opinion without teeth. I'm not long, I'm not short. So take this opinion for what it's worth, which is very little because it's not strong enough to cause me to take a position. I think that Microsoft has demonstrated the ability to handle and navigate changes in the economy, changes in technology, changes in the political atmosphere. They've been able to demonstrate navigating that very well. And I think what they're doing right now is just the latest demonstration of that. So I think it's a solid company, but again, I'm not long. So take that for what it's worth. All right, guys. We've been going for a little over an hour now. I'm gonna call it quits here. Won't be doing any live streaming next week, doing a little bit of travel with the family, but I do have YouTube videos that I've recorded that will still be coming out. But after that, we'll get back to live streaming normally. Appreciate you guys. Lots of good questions today, and we'll see you guys next time.